Good evening. This is Ken Long from Tortoise Capital with a review of the daily trading plan for June 24th, 2013. Market is in bullish volatile conditions still. Looking at a weekly RSI 14 value of 53 puts us right in the middle of neutral on a long-term basis. On a 10-day basis using the 10-day NDX, we had a breakdown today to -5. That would be my daughter coming home. Looking at the market mosaic indicators here. Percent stretch relative to the 200-day moving average is yellow, bullish at 4.68%. We lost another couple percent today, so we're now about 2 2/3% above the sideways market as we define it. Slope of the 50-day moving average is red, bearish at 0.07%, basically flat. ADX has increased trendiness to 21.4 with bears in charge, starting to approach strong trending behavior. ATR percentage has increased to 1.55%, high end of volatile, as you can see down here on the volatility chart. We're more than 2 standard deviations above the 100-day norm. The risk index, which is the VIX 30-period moving average divided by the 10, is at 0.87, which is risk off. And that equates to a Z-score of -1.65 when looking back at the last 5,000 days. You can see the time series of the last 90 days here, how we're well into the risk off category, very extreme risk off. Overreaction signals in the S&P, NASDAQ, diamonds, mid caps, and small caps, so all the U.S., and then all the U.S. on the channeling have fired. Here you can see the increasing strength of the trend using ADX with the bears firmly in charge, increasing volatility. That's not good for the long side. Lots of channeling and overreaction signals, as you can see here, plenty to choose from inside the Dow. 30. Cisco is on a triple screen, and we have a lot of symbols that qualify on 2-to-1 using the auto framer. Just about everything in the Dow test out at better than 2-to-1 on the auto framer. With American Express, Travelers, Bank of America, Home Depot, and IBM as the max pain range compressions. A lot test out on single digits on RSI 2. So something like Travelers ought to interest you with an RSI 2 value of 4, 3.3 on the froggishness, and number 2 on max pain range compression with a 4.7 to 1 reward to risk ratio. The winners today: Microsoft, Walmart, Johnson & Johnson, and United Health, which actually turned in positive days. And the big losers being Intel, Alcoa, Hewlett Packard, and Bank of America. Only one doji in Verizon. The ETFs, only Japan and the VIX do not test out better than 2-to-1. A couple dojis here in XIV and Japan, but everything else test out at better than 2-to-1. We even have gold here with a 6.8 to 1 reward to risk ratio. Plenty to choose from on RSI 2 in the single digits. These here are the S&P sector spiders of technology, industrials, and financials. All test out well on RSI 2 and very strong froggish qualities and are channeling an overreaction. In the auto framer, you see the ones that test out better than 2-to-1 on reward to risk based on a mechanical entry and a retest of the 10-day high, and then using either the range risk or 1 ATR for computing the initial risk that seems reasonable, along with all the framing data posted here for you for developing your trading plan. Looking at the slope of the regression line continues to get worse with today's breakdown below previous day's low. Again, you can see the slope of the 30-day getting progressively worse. It's now 4 standard deviations below where it was when it made a high up here at 168. We've now um, moved 4 standard deviations of adverse slope. You can see the percent stretch is now at the low uh, of the last 6 months in terms of price relative to the 200. I'm sorry, slope compared to the last 180 days, and even the price compared to the 200 is pulled back 3 full standard deviations to rest. We're only a couple percent above the sideways market now, so this is a market getting progressively weaker. And the remaining charts, just for reference data. When we look at the last 10 days in the S&P, um, the market has lost 3.19%. That's a z-score of -1. So we're at the lower boundary of normal in terms of losses over a 10-day period. You can see the losses over a 20-day period down 5.5% is a negative z-score of -1.28. Over the 5 days, the loss of 4.74% is almost a z-score of 2, so it's been a vicious 5-day sell-off here. You can see all the z-scores for the holding periods of all these primary indexes, and some selected large caps are mostly in the red. Very painful selling across the board. That's typical for bearish market action in which everything moves south together and the old correlations start disappearing and everything converges on the negative side. You can see the sell-off has continued to break down out of the river today. Now both the 10 and the 30 period regression lines slopes are below -1 on the z-score, and the 90-day regression line slope is pulled back out of extreme conditions into the normal channel. All that really means is that there's even more room for it to get worse. And just finishing up with some reference data. So the market continues to favor the tactical trader. The increasing volatility and the fact that we're extreme oversold conditions across the board suggest potential follow through in either direction tomorrow. So be agile and let price be your guide. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.